Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. We hope you had a great Thanksgiving holiday, great weekend with family and friends, and now we're back to it with the EIA show. I know we missed last week, but I did put out a quick Twitter thread just to keep everyone abreast of what we thought was happening. And we'll touch on what happened on Friday, which for those that remember the Friday after Thanksgiving in 2014, you can attest to the fact that we've seen this before. It's unkind to do it after a holiday when obviously you have low volumes, but we'll touch on why did it happen and where do we think it's going to go from here, especially as we head into the OPEC meeting tomorrow. Today, the OPEC is meeting just to go through some preliminaries. When you look at the structure for 2022, they vote for a new head. They rotate every year. So that's something that will happen today. And then they'll have the final discussion tomorrow when we're talking about whether there's going to be production increases, production cuts as we go into January. So that's something that we're going to talk about in segment 3. And then when on the FSC show on Friday, we'll talk about what did they do, how did it happen, and where are we going to go from here. And then we're in the last segment, we're also going to touch on what happened with the SPR release. Does that matter, and why does it or doesn't matter going forward? So one thing that we want to look at here is when we start talking about the aggregate, and this is looking at total oil and product stocks. Again, we like to look at what's happening around the world. And one of the interesting things that we've seen so far, and it's actually been increasing, and there's a slide on it in segment 3, is the amount of crude that is on the water. And there is a significant amount now on the water when you look at not just on the storage side, but also what's in motion. And one of the big reasons why is because in November, there was a big increase in exports, mainly from Kuwait, Iraq, and Saudi Arabia, combining for about 640,000 barrels a day additional compared to October. So you see this big increase in exports coming from the Middle East. But at the same time, you also have a lot of crude that was going from floating storage in one location to in motion and will likely end up at floating storage in another as it waits to get offloaded into onshore storage. So that's why we like to look at some of those different economics and what's happening. Product stockpiles had a nice drop last week, and I should say the week before. As you look at some of the drawdowns that we've seen on the middle distillate side, light distillate has gotten a bit worse, especially when you look at Asia. So the total oil product stockpiles will reverse higher. Still being a bullish backdrop, but as we were saying, we expected just to go a bit sideways on the total oil product side and be much closer to what is seasonally normal when we're thinking about the total aggregate around the world. And then when you look at oil, land and floating storage, we're still above the average from 2017 to 2019. And then once you put them all together, we saw the deficit expand a bit from 16.2 to 30.1. But then based on the numbers that we saw today from the EIA, what we're expecting from Singapore and Europe, we'll see that gap close a bit and tighten closer to where we were 2 weeks ago. So then when we look at what are some of the other backdrops, when we look at different pieces of movements, we want to look at what has moved into Asia because we are starting to see some acceleration, but it's on a little bit of a lag. So Iraq boosted crude exports by 5% in November, hitting the highest level of since April of last year, with exports rising to 3.65 million barrels a day, which is up to 186. Sales to China and India, Iraq's largest customers, jumped, with the South Asian country taking the most Iraqi barrels since prior to the pandemic. Korea and Japan also bought more. And it's interesting because we're seeing the additional buying coming from Asia, but it's again stealing from the sales from West Africa because we continue to see a struggle of getting these cargoes, or I should say normal cargoes that typically go from West Africa into Asia. Instead, we're seeing a fairly consistent move from the Middle East into those nations. And that's going to make it a very interesting topic of conversation when you look at OPEC, because so far as the Middle East, or I should say the Middle Eastern countries that are the big part of OPEC, OPEC plus, and again, including Russia in that, they haven't struggled to sell these additional barrels where West Africa has. So when you look at what they're going to do, it's, well, if they're able to sell the additional barrels, they're able to move them into the market, is there a reason for them to cut? And when you look at the compliance on the West African side, which is anywhere from 180% to 240%, essentially that just means that they're over compliant because they can't sell their crude slates, so they're just leaving it in the ground and they're cutting production. So I think it's important to see that there could be a big divide, because the UAE announced 156 billion, I believe, of additional spending over the next 3 years to increase crude production, and that's something that we'll talk about in a few minutes. And again, these are some of the movements that we're seeing, and some of the disconnect between what's happening in the Middle East with Russia, and then what's happening in West Africa. And it's really the tale of two cities when we're looking at OPEC and what that agreement will be. What our assumptions are going into the meeting, which again is tomorrow, is they'll increase by less, but we will get an increase. There will be some sort of movement. They are expecting a rise in storage for January, February, and March. They've actually increased what they expect to see on a storage level. And just to reiterate, as we talked about in our last EIA show, that's always been the expectation, that there would be an increase throughout in storage for 2022. Now you have the new Delta variant. Now we're past Delta. Now we have the Omicron variant of COVID. What is that doing? Is that going to really disconnect where the market is, where demand is? We don't think it has a huge impact, just because, again, it's a coronavirus. It's going to mutate. It's going to continue to mutate. So far, again, vaccines have kept the hospitalizations low, which I think is the biggest concern when you look at previous orders. So, but it's still going to change how people shop, how people go about their day, because just because you may not, go to the hospital because of it, nobody likes getting sick either. So if you could try to minimize exposure, again, those are things that could happen where people are like, well, do I go to the store today or do I go next week? Again, you're just going to see some of that general pause. So now when we look at land storage, and one of the things that we've been saying is we expect this to go a bit sideways. We expect east of Suez land storage to pick back up. We've seen a fairly healthy drawdown, but we're also seeing a big surge of crude that is heading into that direction. So we do expect to see some of that gap close. It's just more of a timing delay when you look at land storage versus offshore storage, as west of Suez really remains flattish for the most part, as the PADD 3 tries to manage liquids tax. Now we're in December 1st. They're going to get more focused on how do they limit the amount of crude and product within the region to limit some of that taxation. And then when you look at what's happened in Europe, land storage has really come way down as offshore storage has increased. So again, we expect to see some of that come closer. And here you can see the deficit narrowed from 45.6 to 42.4. We expect that to continue to narrow, but again, still remain in a fairly bullish backdrop. Now, on the floating storage side, this is where we continue to see a lot of these different separations. The surplus narrowed from 29.4 to 25.1. And that's really, again, on the back of east of Suez. And it comes down to what we've been talking about, of some of that crude going from floating storage into oil in transit. And then that will start to backfill into the east of Suez. But then when you look at west of Suez, we've seen a flip. And it's not because of West Africa, because West African floating storage has actually come down. It's because now we've seen that big increase in Europe, North Sea, and the U.S., which we expect to normalize a bit, especially in Europe, which will help offset some of that land storage versus floating storage. Now, when we start talking about activity, the congestion for China still remains slightly subdued, getting into some of this normalcy. Just below 100, Europe had a spike. This doesn't show some of the Omicron issues. So again, we've seen that drop down. It's still just below 100, but again, you're still seeing a fairly strong movement as things in the rest of Asia and the Americas flatline along these levels, as we've seen with Google Mobility. You will obviously see a bit of a drop given that we had Thanksgiving. You'll see that surge and then that drop down. And then as we go into the next few weeks, we'll see it stabilize and then drop a bit more as we head into Christmas. And then Apple Mobility, again, you're starting to see a little bit of that rollover, but those are things that we're going to talk about in a minute. So then when we look at crude oil stock, we had a small draw of 910,000 barrels. We're still 53 million below the 5-year average, but it's a matter of where is it happening now. So as you can see, the draw was really driven by PADD3, which had a drop of 2.81 million barrels. That now brings it 1.2 million below the 5-year average. And trending closer to where we were in 2019. Which again is going to manage how do they try to maintain runs, adjust some of the different flow through, because again you're trying to manage that tax bill. So, but then when you look at the Midwest had a build of 2.5 million, bringing us to 25.4 million below the 5-year average, and then Cushing had a 1.16 million build, bringing us to 23.2 million. And remember the shift in PADD3 is going to keep some of that crude up in Cushing, and we expect to see that continue to happen and keep those builds fairly healthy in Cushing and in PADD2, because you also have a lot of the Canadian crude continuing to come down. We've seen those increase in imports that we've been talking about, and we don't see that really stopping. Then when we look at factor in the SPR, there was a draw of 2.86 million barrels. Now, one of the things that we want to talk about is, remember one of the nice surprises from last week? Well, I shouldn't say a surprise, but something that happened. So there was an announced 50 million barrel draw from the Strategic Petroleum Reserve in the U.S. 18 of that was already scheduled, and that is going to be a straight sale. 32 million of it is going to have to be reissued, or there's going to be you're going to issue it and then you're going to pay interest and you're going to have to return those barrels. So we have a slide later on in segment 3 where we'll look at some of those different specifics of what that crude is, when does it have to be delivered. But all of that is being sold is sour. And all sour means is it's high in sulfur. And the problem is right now that those barrels don't have a huge market right now because of the cost of refining. And instead, sweet barrels are more in vogue at the moment. So when you look at some of the issues, when you look at some of the price now normalizing a bit, it's going to be difficult to see those nominations. So there's still an opportunity. There still might be some individuals based on refiners or trading houses that might want to take that, try to close that arb, and especially with backwardation where it is, but the quality of it may just make it harder to sell because the price is going to have to be right because it's going to cost more to turn that into product that we need. So again, those are some of the different pieces, and then you have some interesting comments coming from the Biden administration talking about how crude prices have fallen and they expected gasoline prices to drop instantly. And if you read through the insights that I put out about 3 or 4 weeks ago, it takes about 4 months for a physical barrel to actually turn into product. So and reach the market. So again, some of these comments can be a bit outlandish, but we have seen some prices come down. But as the cheaper barrels start to get moved through, then that will help a bit. But again, that takes time to see that move all the way through the system. Now, when we look at crude oil inventories, here you can see that flatlining that we've been talking about. We don't really expect much movement up or down on the crude oil inventory side. And that just means that comps get a touch easier, and especially as you see some of that movement down in 2017 and 2019, but we don't see too much movement in one way or the other. What we've seen, November loading shipments of clean fuels, were from Asia to the Americas were fairly healthy. We see that maintaining some of that flow in December. It'll be a bit reduced, but again, it's still going to be a fairly steady move given some of the shortfalls that we have on the distillate side. Now, when we look at days of supply for crude, you can see that it's still fairly normal. It's hanging right around where we were in 2015, just above where we were in 2019. And it's really just because even though crude stockpiles, and when you look at the 5-year average, is still fairly low, we also have a fairly reduced, and again, it's closing that gap. But when you look at refinery throughput, that still remains a bit off of normal, which is keeping this days of crude supply fairly in line, because as this is just a straight calculation of how much crude is in storage, how much crude is being pulled into refining, and looking at that holistically. So again, there's still more than enough there to keep everybody comfortable. Now, when we look at total U.S. commercial oil storage and products, you can see that we're starting to tip back up. We did have some sizable builds in both gasoline and distillate, even though we had a small draw from oil. That's something that we expect to continue, and when you look at seasonal norms, seasonally speaking, this is normally when this happens, where you have some of the crude coming down and you have products building, especially on the gasoline side. And again, it's very seasonally normal, so we don't expect anything really surprising in one way or the other. Now, when we look at gasoline storage, as we said 2 weeks ago, we expected to see a nice pivot up. And you can see, just based on previous years, that pivot can happen depending on when refiners come back. If you remember from earlier, because of Ida, a lot of refiners delayed their downtime. So when you look at this, you can see that there was essentially the delay in turnarounds. Now those turnarounds are ending, and you're starting to see that build back up, and that's going to continue to move in a positive direction. And here is something where, again, you can see the pace. The pace is right in line with where things were from back in 2017, 2019. We just see it being very seasonally normal at this point in time. Then when we look at distillate's still fairly low on a 5-year average, not as bad as what it looks like when you go over the last 29 years. But we started to get a little bit of an increase up. This is now going to be a weather question on top of where is production, where are exports and imports. Things have gotten a little bit warmer. So again, that's going to reduce some of those heating demand days, and that'll help stabilize a bit where distillate is going. Our exports have come down a lot. There still is a decent amount of Middle East and Asian middle disti coming into the European markets, which again is just going to keep our exports trapped. Based on these numbers, there's really no incentive to push it into the international market. So again, it's just going to keep more stuff onshore versus offshore. Then when you look at jet, again, just managing, some of this can be left in the kerosene pool, other can be left in distillate, so you had a nice drop. This is something that will start to reverse as demand normalizes now that we're on the other side of Thanksgiving, where we see that normal spike in activity. This is looking at the crude curve and how aggressive Friday and earlier this week were. You can see where we were at about 85 and how, based on where we are right now at about 67 and a quarter, you can see that big drop. And this is why we were talking about hedging. Again, we're not saying that you hedge your full book, but this is why you try to pick your spots, try to protect some of that cash flow, especially when you see some of these opportunities. As we've been saying, we feel confident about that back end of the curve, where what we were expecting was more of a flattening, where the front months just really ran ahead of where really things should go into. And that's where now you've seen some of that normalizing. You've seen some of that pressure come down in the front months. But again, when you look at where we are going through 2024 into 26, and this is coming to where are companies looking, where are NOCs looking, IOCs looking for an investment side. And a lot of these projects are sanctioned between 55 and 65. So when you look at this curve, there's still enough to say that we're going to start to see a bit more capital going into the market. We've heard it from the UAE. We expect more to come from the Middle East. And Angola BP brought on a small field in Angola, just about 40,000 barrels a day. But again, this is just some of those small little projects. That was a bolt-on. That was something that is just going to be a tieback. There's more opportunity in Latin America, and this is why it's going to be interesting to see where's the front month versus the curve. And we just thought the front month, as we've been saying, was grossly overstated, and here's some of that snapback that we've been discussing. So then when we look at what's happening with COVID, just to provide some of this update, you can see on a worldwide level, things are fairly stable. The U.S. is starting to creep up, but again, where are we right now? Well, we're in winter. So this is typically when you start to see those increases. We expect those numbers to rise. How prevalent Omicron is versus Delta. One of our views is this new variant has been traveling the world for the last several weeks, if not months. So it's just a matter of it being caught. But again, I think it's already where it is. Here you can see Germany has that increase. There will be some restrictions, but not a lockdown. Austria, as we know, did those lockdowns, and some of the case counts have come down. Vietnam has seen a fairly steady increase in cases, the same with South Korea, while India remains fairly low, and that's keeping the Asia Pacific a bit muted, even though when we look at the UK, that is stabilized. Europe is trending up a bit. We expect Europe in general to continue to trend higher. And this is where you can look at the US, and the US typically lags Italy, the UK, by about 2 weeks. So the question is, are we going to start to see some of that snapback? I'd say yes, but again, I don't think it's going to be a huge point of concern for demand. Now, going back through the last 29 years, looking at PADD 3, you can see that we're trending closer to 2019. I expect us to continue on this trend. And then once we get there, see a little bit of a balancing act between activity and where some of these flows are going to go, trying to manage some of those tax bills, as we keep saying. Here's some of that reversal in Cushing. We expect this to accelerate a bit and look like 2014. If you can see that copper light color, that's something that we think will just continue to move up again at a very steady rate. And if you look at that rate of increase, it's just you're going to have PADD 3 keeping product out of the region, and that'll keep more in Cushing in general. And then when you look at just those general movements, that you can see that is going to continue to accelerate. And we're just going to see that close at closer to the highs that we've been talking about from previous sessions. Then when you look at runs were increased just 0.2. As we were saying prior to to Thanksgiving, we expected to get to about 89. We're right at 88.8. It's about 1% below the 5-year average, because at this point we're pushing much closer to about 90, on our way to 93, 94% utilization rate. And when you look at what are some of those activity levels declined, it's really PADD 3, PADD 1. PADD 3 is the one that we think is going to try to manage some of those flows, again, speaking to what's in storage and where's some of the opportunity. Imports have increased. Imports increased 168,000 barrels a day. It's still below the 5-year average. PADD 3 saw a nice spike of 363,000. That's still about 600,000 below the 5-year average, with PADD 1 closing the gap a bit with an increase of 143,000 barrels a day. PADD 3 is going to manage some of those imports. They have a very specific cut that they're looking to do: heating oil, diesel, some of that lighter disti, and then that gasoline side. So that's where they're gonna try to manage some of that heavy with the light, and that's where we'll see some of the floating storage increase. Imports be obviously lumpy just based on timing, but still be at an elevated level versus where we have been over previous months, though it will still be below that 5-year average. Now, PADD 5 had a drop of 482,000 barrels a day. That brings us 12,000 below the 5-year average, so still fairly in line. But remember, the lumpiness will remain just given the issues that are at that port. Now, when we look at implied demand, you had that nice spike for last week, and that's just priming the pump ahead of Thanksgiving. A lot of things that we expect, that nothing abnormal in that. And then you have that drop off that comes at the back end of Thanksgiving. You will see a little tick higher just because you will see some activity pick back up. Make sure that things are fluid and well supplied. So again, but then once you get that last little bump, then you'll start to see that grind a bit lower on the jet fuel side as well as gasoline, as we do expect distillate, or I should say diesel, remain fairly bid, and that demand still remaining above the 5-year average and still remaining strong. A little bit, again, just kind of bouncing around up and down, but still elevated. So gasoline had a drop of 538,000 barrels a day. Distillate had a drop of 182,000 barrels a day. We expect the distillate to have a bigger pop off that. Jet fuel had an increase of 217,000 barrels a day. That's that restocking. Gasoline, it's all about timing, really. And then when you look at propane was up 49,000 barrels a day, 338,000 above the 5-year average. Still, again, very healthy in general. Then when we look at what is happening in floating storage is increasing. We're at the highs that we saw from the end of, or I should say the middle of August. We expect this to continue to trend up, again, at a very steady pace. We don't think there's going to be a huge surge up or down, but a fairly steady grind higher. Then when you look at imports, we're starting to see that's the small increase higher. We expected just to reach some of the peaks that we saw in August, and the ones that we saw just above what we saw, just below what we saw in September. And it's just going to stay at the lower end of the cloud, but still, again, remain within that cloud, but below the 5-year average. Imports into PADD 2 surged again. You can see that we're nearing the highs of 2021. This is, again, the line 3. This is the movements that we've continued to see. And we do expect these to remain elevated. It will swing up and down, but we're going to stay well above the 5-year average. And as you can see here, setting an seasonally adjusted new high. And then when we look at refinery utilization rates, just rounding it out, you can see that we're just below where we are over the last 29 years. We don't expect that to really change. Typically, we're right around that 90 level. We expect to see some of that close. Again, we're about that closer to 89. We expect to see about another 70 basis points come back up. We had PBF in Toledo come offline because of a fire. Some of that is still operational, some of it isn't, and as that gets repaired. But again, those are some of those increases that we expect, getting us closer to that seasonal normal of 90 on our way to about 91. But there's going to be that timing delay of, do we have the right crude? Where is the crude delivered? So those are some of the high levels. And now in the next segment, we're going to go deeper into U.S. Product demand, U.S. product supply, and what do we see happening into year end.